What if I told you that you could start building your financial future with just $1,000? Sounds impossible, right? I mean, what can anyone possibly do with only $1,000? Well, you'd be surprised. Today, we'll show you how it's not only possible, but also easier than you might think. Investing isn't just for the rich or the financial whizzes. It's actually for everyone. And whether you're a college student, a young professional, or someone looking to grow their retirement fund, investing is a powerful tool that can help you achieve your financial goals. Make sure you watch till the end as we break down the investment options and guide you step by step on how to start your investment journey with just $1,000. And before we get started, if you're new here, make sure you subscribe and hit that bell icon so you don't miss out on our next videos. Now let's clear up some common misconceptions that often hold people back from taking their first step. And the first one is probably the most common myth out there. Many people believe that you need to have a lot of money to start investing, but that's not true. Thanks to modern technology and financial innovations, you can start investing with as little as $1,000. It's all about getting started and consistently investing over time. Another myth is that investing is like gambling. While it's true that investing involves risk, it's not the same as gambling. When you invest, you're buying assets that have the potential to generate an income or increase in value over time. So technically, it's not about getting lucky. It's about making educated decisions and being patient. Talking about educated decisions, there's also a myth out there that you need to be a financial expert to invest. Financial knowledge can certainly help, but you don't need to be an expert to start investing. There are literally plenty of resources available, even like this YouTube channel, that can help you understand the basics. Plus, there are investment options that are designed for beginners. The power of $1,000. Now, why did we mention only $1,000? I mean, we could have said $5,000 or $10,000. First off, understand that every investment journey starts with a single step, and that step doesn't have to be a giant leap. It can be as small as $1,000. The key is to start. Start small if you need to, but start now. And there's a magic thing called compound interest. Albert Einstein once called it the eighth wonder of the world. He said, "He who understands it, earns it. He who doesn't, pays it." If you don't know, compound interest is essentially earning interest on your interest. Over time, this can turn your $1,000 into much more. There is another strategy called dollar cost averaging. This is where you invest a fixed amount of money at regular intervals, regardless of the price of the investment. And over time, this strategy can help reduce the impact of volatility on your investments. Now, with a better understanding and $1,000 in our pocket, we're ready to invest. The question comes, where do we put our money? Let's start with some of the latest and most exciting investment options of 2024. First up, we have AI stocks. As we move further into the digital age, AI is becoming increasingly prevalent in our everyday lives. Investing in companies that are leading the way in AI technology can be a smart move. These companies are creating innovative solutions that are changing the way we live and work. The benefit? You get to be part of this technological revolution and potentially reap the rewards as these companies grow. Next, we have an option of emerging markets. These are countries that are experiencing rapid economic growth and industrialization. The benefit here is the potential for high returns as these markets grow and develop. If these two options sound too modern or complicated, let's move on to some of the more traditional investment options. Let's start with bonds. When you buy a bond, you're essentially lending money to the issuer. It can be a corporation or even government. In exchange, you get periodic interest payments and the return of the bond's face value when it matures. Bonds are generally considered less risky than stocks, but the returns may also be lower. The plus point is that they provide a steady stream of income. If you want a mixture of bonds, stocks, and few of your other assets, then you go for mutual funds. They pool money from many investors to invest in a diversified portfolio of your assets. Mutual funds are managed by professional fund managers. This can really be a good option if you're new to investing or don't know much and want a more hands-off approach. There is another similar option, ETFs. They are a type of investment fund an exchange-traded product, meaning they are bought and sold on the stock exchange. ETFs are an excellent way to diversify your portfolio because they contain a variety of different investments like stocks, commodities, or bonds. They offer the diversification of mutual funds but can be bought and sold like individual stocks. There is another exciting option for you, robo-advisors. They are digital platforms that provide automated, algorithm-driven financial planning services with little to no human supervision. A typical robo-advisor collects information from clients about their financial situation and future goals through an online survey, and then uses the data to offer advice and/or automatically invest client assets. The benefit here is that you get a customized investment plan and automated investing, saving you time and effort. Now, with so many options, how do you manage the risks? First of all, understand that risk is a part of investing. The value of your investments can go up and down. It's real life, and it happens. Don't let that scare you away. As we mentioned in many of our videos, one of the most effective ways to manage risk is through diversification. This means spreading your investments across a variety of assets, sectors, and geographical locations. The idea here is that if one investment doesn't perform well, others might. If you look for the latest trends, you might find the use of intelligent automation in risk management. This involves using technology to automate routine tasks, freeing up your time to focus on strategic decision-making. It can also help you keep track of your investments and make adjustments as needed. Another emerging trend is the incorporation of climate risk assessment into the risk management framework, which involves considering the potential impact of climate change on your investments. For example, companies that are not taking steps to reduce their carbon footprint could face regulatory penalties or reputational damage, which could affect their stock price. Moving on, advanced analytics is another tool that's transforming risk management. It uses data science and AI to analyze new forms of data, such as social media sentiments or alternative financial indicators. This can provide a more nuanced understanding of emerging threats. On a side note, understand your own risk tolerance. This is a personal decision and will depend on factors such as your financial goals, your time horizon, and your personal comfort with risk. You don't need to take on as much risk as possible, but take on the right amount of risk for you. Creating an investment plan. Up till now, we've explored some exciting investment options and talked about risk management. It's finally time to create an investment plan. Our goal is to create a good plan that you can stick to even when the market gets tough. The first part of the plan is to define your financial goals. What are you investing for? A new car? Retirement? Your child's education? Having these types of clear goals can guide your investment decisions. The next part is to determine your time horizon. How long can you leave your money invested? Generally, the longer your time horizon, the more risk you can afford to take. As we mentioned earlier, all investments come with risk. It's important to understand how much risk you're comfortable with. Based on your goals, time horizon, and risk tolerance, decide which investment options are right for you. Remember, diversification is key. Now that we have a plan, it's time to put it into action. The first step is to open an investment account. This can be done through a brokerage firm or a robo-advisor. Look for one that has low fees and a good reputation. Once your account is open, you'll need to fund it. Now you need to decide how much you want to invest. This is where our $1,000 comes in. You can usually transfer money from your bank account directly into your investment account. Now comes the fun part: choosing your investments. Refer back to your investment plan and use it to guide your decisions. Once you've chosen your investments, it's time to make your first investment. This can usually be done online, like we said, through your investment account. After you've made your investments, it's important to monitor them regularly. Investing is a long-term game, not a set-and-forget thing. There will be ups and downs, but stay focused on your goals. If your investments pay dividends or interest, consider reinvesting this money. This approach has been used by many successful investors out there, and it can help you too with your $1,000 grow even more over time. Well, that's it for today. We started by busting some common myths about investing, and then we explored the power of starting small with just $1,000. We discussed various investment options, including some of the latest trends like AI stocks and emerging markets. We also talked about the importance of risk management and how to create a simple, practical investment plan. Finally, we walked through the steps of getting started with investing. You're now equipped with the knowledge to start your investment journey with just $1,000. If you enjoyed the info in this video, we'd love to hear from you. What's one thing you learned from this video that you'll start implementing in your investing journey? If you have any questions or topics you'd like us to cover in future videos, drop your comments below. And before you go, don't forget to check out our video on what separates the wealthy from the poor, rich versus poor mindset. Make sure you hit that subscribe button and press the bell icon. Thanks for watching.